you will not make money, which is why I believe financial literacy cannot be spread. People should have the right temperament, and most people don't have the right temperament to be financially literate or to be wealthy. You should say inaction is the most important aspect of portfolio management. The more you are going to complicate your portfolio, the more it becomes difficult to even say, I have this asset. It's a mess. Most people's portfolios are complete mess. They want theoretical ideas about asset allocation, retirement planning, etc. But if you look at their portfolios, it's a complete mess. If you do a retirement planning calculation for the first time, and if you are not shocked by the result, or if you are able to sleep comfortably after doing the retirement planning calculation, either you are very frugal, you are earning a lot of income, or you have done something wrong in the inputs. For most people, they want to sell dreams. They want to be sold dreams. They like people selling them dreams. So I ask your viewers, what do you want? Do you want a guy who offers you motivation and encouragement by giving you wrong inputs, wrong assumptions, or do you want to listen to a person who is more practical? Retirement planning is a dynamic process that you need to do every year, because the inputs will change, the assumptions will change, the economy changes, the country changes, your personal circumstances changes. So you have to redo the calculation every year. It's not I will do it once and just invest and forget about it kind of situation. If you want to talk about the retirement planning, you must have clarity in portfolio management and how simple your portfolio should be. If you don't aim for simplicity in your portfolio construction, you will have a mess with your retirement planning. And people are going to curse you when you die. If you have a cluttered portfolio, people are going to curse you when you die, because they want to get money from this instrument, they're going to get money from that instrument. They will curse you. Don't do that. Keep it simple. At least your nominees will be happy.
Hi guys, welcome to HussleFreeWealth. I have with me Pattu from Freefincal. He has been financially independent for a while now and has been instrumental in getting many people on financial freedom path. In this video, we're going to cover, how much money someone needs to retire, questions on asset allocation, and plenty more, depending on the time that we have available. So thank you, Pattu, for joining.
My pleasure.
Okay, I'll directly come to the first question. How much money does someone need to retire by 40? I know you won't be able to answer this question without the assumptions. So I'll take some of the assumptions. So let's say they have a 50-50 equity debt allocation and a separate buffer for other goals.
Yeah. So, see, this is a very difficult question to answer. I find on the one hand, the people give offhand very easy answers to this. But practically speaking, this is a very difficult question to answer, and I'll explain why. So let's say ideally that this person that we're going to talk about, who wants to retire by 45, maybe let's say 50, just to be, because 50 is now the new 60, I would say, for retirement planning. For our parents' generation, 60 was the retirement age, but I think that has now gone down to 60 gone down to 50, excuse me, because of the kind of corporate culture we have, because of the stress that we have, etc. So we'll just keep it as 50. 50 is normal retirement. Even if one is active, by 50, they should become financially independent. That should be the goal for everybody. And that I would consider as normal retirement today. Maximum 50. So let's say somebody who has become financially savvy at a very young age, let's say at age 25. So they just started working, 1-2 years they've into the job. They just started reading some things about tax saving. Usually it starts with tax saving, right? For everybody, they want to save tax, and they want to get better returns. Maybe they talk about fighting inflation, and then slowly it leads to financial planning. So at that stage, when you want to start your financial planning journey or retirement planning journey and say, how much do I ask this question that you asked, how much do I need? At that point, if you use a very standard, reasonably okay calculator online, there are many online calculators. Of course, people now use Chat GPT. They used to type two entries in a calculator and click calculate. Even that has gone now. They just type in Chat GPT and assume that whatever it says is right. So that's another danger that we have now. But it's available, and typically they would they would the target would be 30x. That's the kind of calculator and typical answers that the calculators will churn out. And what does 30x means? 30x means 30 times the annual expenses at the time of retirement, not now. So that would be the kind of corpus. So which means that so you will have to take into account your present lifestyle, your present expenses, inflated by about 7%, 8% inflation to over the next 20 years, 25 years. That's the time of retirement, and then multiply it by 30. So that's something that, I mean, I don't like to use thumb rules because look, you have so much tools today. It take 2 minutes of your life to punch it in and find out. So let's not give you, I would say 30x, but 30x is at future expenses. But the problem now is, if sorry to let me finish it. The problem now is that how do I project future expenses? Everything is an unknown. I'm just 25. I'm probably not even married. I'm going to get married. I don't know who to. That person may be financially compatible with me, or it can be my worst nightmare. All sorts of problems. Then comes children, then comes taking care of in-laws, taking care of parents. There's a huge, family process and evolution that happens. So our this this target, the how much do I need to retire is actually a moving. It's a moving target. It's moving. The goalpost is continuously changing. It takes some time to appreciate it. It is not something that you can appreciate at 25. You can appreciate this only by, I would say, 35 or 40. It takes 10 years of investment and 10 years of looking at your expenses and what happens to you. Life has to happen to you. That is when you understand the ups and downs. You can appreciate risks only when life happens to you. If everything is smooth, then things are, you have a very different perspective. So I would say to start with, aim for 30x, where x is your future expense, and use about 8% inflation to inflate your current lifestyle to the future lifestyle, to the lifestyle at the time you retire. So that will be the starting point. But this will keep changing every time something happens to you. Every 5 years, every time your family situation changes, your expenses change. People say inflation is 6%, 7%. I would say inflation for young people, even up to age of 50, 55, even up to 55, I would say it's close to 9%, 10%. Because the most of the inflation that you have is lifestyle changes. It is not the government reported inflation of 4%, 5%, RBI did this, RBI did. That doesn't matter. That is completely irrelevant to the common man. I mean, I'm practically speaking, because tomorrow you're going to buy a better phone. Tomorrow you're going to ride a better bike or buy a car, buy a second car, and you're going to buy a bigger TV, and you're always going to enhance your lifestyle. And as your lifestyle enhances, the retirement corpus is going to grow, right? For example, I am recording this on a Mac Pro, right? The Mac Pro cost me 2.5 lakhs 3 years ago or 4 years ago. Now, okay, I got that. I had some money, I bought it. Now, how do I account for this in my retirement calculation? Nobody does it. Because if my Mac Pro crashes today, or let's say when I retire and it crashes, what will I do? Will I say I'm not going to use a computer at all? I've been using Mac all my life. Will I say I'm going to downgrade myself? How will I pay for even repairing a Mac Pro is pretty expensive. Anything associated with Apple is expensive. Half-bitten Apple is expensive. So how I would say most people don't even know how they will buy a new washing machine when it breaks down after they retire, because that's not factored into the retirement planning calculation. Most people don't do it because they will say, what are your current expenses? Your current expenses does not include how much you will pay for your new phone, your computer when it breaks down, or your washing machine when it breaks down. It's a mess. No, now you're wondering, maybe I should not have called him on.
No.
I mean,
No, these are the factors that I have also included in my annual calculation, right? So there is a separate bucket for all of these replacement of tools that I have. Uh, but then even if you do that, right, 9% or 10%, the moment I start calculating anything at 9 or 10%
Inflation.
inflation, yes, uh, you know, which means practically I'm going to get zero or negative portfolio returns. How do I even plan the corpus, right? Do I take it at 0% real return, -1% real return based on my expenses? No, I'm not talking about those folks who have a lot of discretionary expenses. I'm talking about people who have very little discretionary expenses that have been baked into their retirement corpus calculation. So for them, how much should be the inflation that needs to be taken if someone has already accounted for all of these as a separate buffer, right?
I would
Replacement of.
see see it's for somebody who's struggling to see. See, the problem is this. I would say like this. When we teach quantum mechanics in class, and the first thing we say is, if you are not shocked by quantum mechanics, you have not understood it. If you do a retirement planning calculation for the first time, and if you are not shocked by the result, or if you are able to sleep comfortably after doing the retirement planning calculation, either you are very frugal, you are earning a lot of income, or you have done something wrong in the inputs. For most people, they want to sell dreams. They want to be sold dreams, I would say. They like people selling them dreams. So I ask your viewers, what do you want? Do you want a guy who offers you motivation and encouragement by giving you wrong inputs, wrong assumptions, or do you want to listen to a person who is more practical? Because if things go wrong, you can't correct it. If I get a big expense, when I'm earning, I get a big expense, I can manage it because I know I'll get my salary on the 30th of the month. That doesn't happen in retirement. That flexibility doesn't happen. You don't have that income. You can't do a retirement planning calculation again. So, to specifically answer your question, yes, most people will be frightened by retirement planning calculation. And if they don't have too much to invest, and if they are going to assume that they are not going to have any discretionary spending in retirement, I would say at least aim for 6% after retirement, 7% before retirement, inflation wise. That's what I would recommend. That's the baseline. Don't go below that. Aim for 7% inflation before you retire and 6% inflation after you retire.
I'll start for viewers who want to do their own calculations. We should not be giving a blanket number because circumstances are different and their own salary, income, expenses are different. So first, we are talking about the asset allocation. Do you think 60/40 is going to give higher portfolio return than 50/50 in long term, let's say in 10 years' time?
The truthful answer is nobody knows.
Okay.
Nobody can know. Nobody, if somebody says they know, they are either selling something or they're just speaking through their hat.
No, but then their reasoning is based on the past data. For example, for equity, I'm going to.
Exactly. All of them come with a small fine print that says future returns need not represent past data. The past does not represent the future, right? So that's the point. You should always plan for the unknown. And no, let's keep it to a focused. I would say choose a asset allocation that you are comfortable with. Some people say I am young, therefore I will take more risk. And just because they've seen a couple of years of bull run, they assume they can handle 80% equity. Fine, you live and learn. Take 80%, sure, handle 80% equity and see what happens. Nothing is going to happen because you're young. You still have the time to fail and get up in life. It's not a problem. So if you're young, choose something higher in equity. That's absolutely fine. But the problem with investors is they want to believe that they have chosen the right thing. They want to believe that they have taken the best decision. That's immature. You choose something suitable for you. If you think 80% works for you, choose it. If you think I'm okay with only 40% equity, that's absolutely fine. But invest the necessary amount.
So this is what happens, right? For folks who have invested in the market for a long time and they are comfortable with equity allocation. So for someone like me, I understand the cycles, and then for a long period of time, I could get probably no return, and I'm okay with that. I've factored in all of those in my plan. But one of the question that could come is, uh, many people talk about 60-40 allocation as the allocation that is probably going to give best portfolio return per history, etc., etc. So, what is the asset allocation that I should strive for to get the best possible return? Because that's what the focus is. If I am able to, take care of my behavior, then the next question comes: which is the most ideal allocation, asset allocation for me? Uh,
See, um, yeah, it's a very interesting question. But again, I don't want to frustrate you by giving you weird answers, and I've been giving you weird answers so far.
no, please. The goal here is to educate folks. Please go
Uh,
ahead.
because everybody wants nice answers. Yes, no, they
No,
want at least not you, but I'm saying. So the thing is, see, determining any initial. First of all, let's understand this. Your asset allocation that you want to talk about is your initial asset allocation. Let's say you choose 50-50 for a as an example. You are not going to hold 50-50 all your life. You're certainly not going to be holding 50-50 at the time of retirement. There's a big if. There are certain circumstances when you can hold 50-50, but typically speaking, I don't think you should plan for 50-50. So I would recommend after retirement, not more than 20 to 30% equity for most people, for normal people, because the YouTube viewers are always saying, commenters are always saying, I'm just an ordinary man. What about me? All this plan is not suitable for me. Let me give you a plan for the ordinary guy out there. 20 to 30% only, not much corpus to play with, not much of discretionary expense, whatever. So 20 to 30% equity is what I would suggest for the normal Joe out there. For those who have a lot more money, they can plan for more equity exposure. We'll come to that. But so your asset allocation is not a fixed thing. It's not going to be held in stone. You have to taper down your asset allocation gradually from, let's say, initially 50-50 or 60-40 equity to this 20-30% equity over time. So you have to change this. But what would be the starting point? How would you determine the starting point? There are two factors here. One is what equity and fixed income return assumptions are you going to make? The asset allocation depends heavily on that. Are you going to expect 15% from equity, which is immature, 12% from equity over the long term, quote unquote, or 10% equity before tax? I would say aim for as low a return as possible, because you you mean if you aim for the first floor, you will be happy if you get to the second floor.
true.
If you aim for the 40th floor, you're always going to be disappointed if you fall anything less, and you can't go back in time and invest more. So you aim for something like 10%. I would say youngsters should aim for 10% equity, not because that they're going to get only that much. I don't know what the future is. Nobody can tell you how much return equity markets will give you over the long term. There are some calculations like 4% GDP plus inflation, blah blah. All those calculations are just nonsense. Equity markets does not listen to anybody. It doesn't follow any thumb rule. It just does what it wants. So you aim for the lowest possible that your investment will allow. Right, 10% before tax is what I would strongly recommend. Okay, if you expect only 10% before tax, the amount you should invest becomes higher. Therefore, okay, if it bothers you too much, make it 12% before tax at best. Don't go beyond 12% from your overall equity portfolio before tax. That's the first assumption you're making, and that's a big assumption. You don't know what the market's going to give you. So, second, how much is going to be your fixed income return, assuming that you have only two asset class. Fixed income, I would say, aim for 7% if it's tax free. We're talking about EPF returns, PPF returns after 20 years. We are not talking about current EPF returns, PPF returns.
Isn't 7% higher because
That's
we have seen gradual decrease in fixed income interest rates, and
if you. I
the
mean,
cycle is going to.
I would appreciate you if you choose less. But I'm just trying to not to dunk you underwater too much. Just saying, aim for something reasonable, because now it is already what, 7.5, 7.5, almost. EPF is 8%, 8ish%, but expect at least 1% fall over the next 10, 20 years, maybe. But if you want to expect 6% from EPF and PPF, it's a solid plan, it's a robust plan. But without too much of discouragement, at least expect 7% and 6% from taxable fixed income, like debt funds.
See, I don't really care, if somebody gets discouraged. Though the channel is made to encourage people, but then the important part is to tell them the realities of the world, right? So even if it comes as a shocker, I'm fine with that. So, uh, do you think for a long period of time, let's forget the long period of time, for 10 years period, 6% of fixed income return. Why I'm not taking 7 or 8% is because 8% is 8.1 or 8.25 is what you're getting in EPF. 7.1 is you're getting in PPF, but there is a lock into that, right? But if you want to spark some money separately, people usually go to fixed deposits, not a tax friendly avenue, but there you get around 6 to 7%. So for a 10-year period, right? I don't know what the future holds after 20 years or so. So for a 10-year period, do I take 6% as a fixed income?
Fine.
As that, would you consider that to be reasonable and logical?
Very realistic. Yes, it is. Reasonable becomes a private point, but I would say it's very practical, because the people who can't invest more would find it unreasonable. That's how it always is. When the Excel shows you bad result, you think it is unreasonable, but it's very practical. And I would say, if you can choose 6%, choose 6%, or push it a little bit higher for the moment. See, the whole point I want to want to convey is that retirement planning is a dynamic process that you need to do every year, because the inputs will change, the assumptions will change, the economy changes, the country changes, your personal circumstances changes. So you have to redo the calculation every year. It's not a I will do it once and just invest and forget about it kind of situation, because everything changes. Okay, if it discourages you too much, choose 7% now from fixed income. Maybe taper it down lower when your income increases, when you get a promotion, or when you get a big salary jump, or you jump to another company paying more. Then you maybe tinker down your fixed income a little bit for the moment, just to get started. Otherwise, because people are always saying I'm discouraging people. So okay, 6-7%, whatever. No, the point now is, you have now fixed your return assumptions, whatever they are. 12% from equity, 6 to 7% from fixed income. Then you choose the mix, which will give you a portfolio return. 50% of this, 50% of this, 60% of that, 70% of that, whatever. You can try different things on a spreadsheet, and that will give you the asset allocation that you're going to hold now. And are you comfortable with this? First of all, your risk at matters. Now, the problem now is, I have seen how Indian investors have changed from no, equity is all gambling to I am 100% equity. The scenario was completely changed, and all it took was only 2-3 years of bull run. People just changed. Now they say NPS has become 100%. No, let me make that also 100%. It doesn't matter what my current asset allocation is. I'll make that also 100%. If it's allowed, I'll make everything 100%. Everything should be in equity. When the market is going well, everybody wants to be in that. But nobody has seen few years of downturn, and they think it's not possible. It cannot happen. It can happen as easily as getting out of bed. It will happen before you even know it, and who knows, it may be happening now. As we speak, it may be happening. We don't know. We only know it in hindsight, right? So you should always plan for that, and you should ask yourself, can I handle such a huge risk? And most people think that they can. At least be open-minded in saying, I have not seen such a big fall, therefore I don't know how I will behave. At least have a little bit of humility in that. You don't need to advertise your humility. At least tell the man in the mirror that I have never seen such a big risk, so I should not be thinking that I can handle it. I think both of us have been investing for nearly 2 decades now, and I can say confidently that if the market decreases 50% tomorrow, and if it stays down 50%, I don't know how I will behave. I can say stay invested, blah blah blah, all those kind of social media messages, but personally, I don't know how I will behave. It's not something that so you must have a little bit of humility and doubt yourself whether you will actually be able to handle it. Do it personally. You don't need to advertise everything. The problem is everybody is advertising everything these days. Just talk to yourself, think alone. Therefore, I would say, okay, you've chosen 50-60% equity. That's enough. If you're okay with higher than that, choose that. But ask yourself, how are you also going to go from the initial asset allocation to what you want to do later? That may be a big jump for somebody in the 20s. For a very young guy, this is a very difficult question, right? I'm saying you have 70% equity now, let's say, as an example, and I'm saying you should aim for 40% equity at the time of retirement, or 35% equity, something like that. So you should go from here to there. How are you going to go from here to there? This is a secondary question that the young guy I want to just start. Don't ask, confuse my brain with such questions. But this is a guy somebody in the 30s or 40s should ask this question very seriously, because this will change the retirement planning dynamic. So that's why I keep saying it. There's not one answer, because as you ask more and more questions about how your retirement is going to evolve, the corpus will keep changing. For the same guy, even if you assume that guy's family situation has not changed, even for that person, as they think more and more about how they're going to manage their money in retirement as they age, the corpus will keep changing, the planning will keep changing. So it's not a very simple thing to say 30x, 4% retirement rule, 5% rule, or 2% rule, whatever. You can't simply give out thumb rules like that. All I'm saying is that I think I don't want to waste people's time, and one important takeaway is that please ask yourself what is good for you and your family, what will work for you temperamentally, what will be your future be. Ask personal questions. All the questions lie within, as our great Maharishis have said, all questions lie within, they don't lie outside. So I'm not sure if I've answered it properly, because
No, you did, because there are a lot of things at play here. You also said 10% is what one should expect from equity, and that is pre-tax. Then we talked about fixed income returns, ranging between 6 to 7%, and then the inflation rate that you said was around 9% or something, but that could change based on your own expenses, right? Somebody could have a lot of lifestyle expenses, somebody could be disciplined and they are able to control it. So maybe the best way would be to just look at the annual expenses over the last few years and just see how it has been for you, and then maybe project that in the future.
correct. As a baseline, I would say 6% for the so-called common man. I would say 7% before retirement, 6% after it. That's the baseline. Don't go below that. No matter how frugal you are, don't go below that. At least aim for that much. Of course, frugality will help a lot, but I mean, this is the problem. I mean, there's an argument that say, I will be frugal, I don't need that much money. That's absolutely fine that you want to be frugal, but will life allow you to be frugal? You may say, I don't want a car, I don't want a big phone, but what about health expenses? You may fall sick and you may have to get into some kind of costly medical treatment that keeps recurring every month and so on. This is the unknown is what can shatter your plans. So that's why I said think deeply about what can happen to you, what bad can happen to you sometimes.
Sure. Thank you for that. We are taking an assumption that these people, they are financially literate, they have educated themselves, they have kind of given them a lot of information about equity, how the cycle plays out, how the history has been. I'm talking about returns here, right? You did touch upon that, But just to give viewers some kind of platform to kind of think on, somebody who's just starting out, what is the asset allocation that person should take? Somebody who is at 25 and plans to retire by 40. Then somebody who is uh, midway through the journey, around 30, 32, uh, and plans to retire by 40. And then somebody who is, let's say, 39 or 40, or who thinks that they are financially retired. For that, you already answered 25 to 30% in equity should be there. And then there is somebody like me that, who is financially independent, but then I still have some runway. I'm still going to probably work for some time. So what should be the asset allocation for people who have enough, but then they are still working? They are not actually withdrawing from their kitty,
So
retirement kitty.
depends on how much corpus you have. For example, I mean, if I can speak for myself, I hold about 60 to 65% in equity. Okay, and my retirement theoretically is about 15 years away, 14 years away, and I still hold 60 to 65% because I have the reason I hold it is that I have enough in my fixed income assets to, I mean, I the theoretical definition of financial independence in my case would be satisfied just by my fixed income assets alone.
Okay.
That makes sense, right? If you
Yes.
consider my fixed income assets alone, that will make me financially independent without including my equity. So my equity is
Buffer.
from that point of view a buffer. So I can hold a little more than what I would usually recommend. So it's a very personal thing. I can't give you, like, you agree that it's you. Every person has to look at their own situation very deeply and then decide what works for them. But the bigger problem now we have is, since we are talking about asset allocation, is how many assets are you going to hold? So it really frustrates me that, so let's say 100 people have asked me, or more than 100 people have asked me over the last few months, maybe even years, how much asset allocation should I hold in? How much allocation should I have in gold? Because gold is moving. When something moves up, everybody is excited and wants to be part of the. Now, I have only one question to ask them. Okay, you want to go to invest in gold. How will you manage your portfolio if you must already have equity, you must already have fixed income, you're going to add now gold. How will you manage your asset allocation or your portfolio with 3 assets? I have not got a single, barely even intelligent answer to that question. Nobody knows. Nobody knows. Everybody wants a piece of the shiny object. Gold is now shining, so they want a piece of that. Silver is shining, they want a piece of that. But they don't ask themselves, how will I manage my portfolio if I'm going to add another asset allocation? Let's understand that we keep talking about asset allocation, but for most people out there, they are clueless about asset allocation because they don't want to rebalance. Theoretically, they know what rebalancing is, but if you ask them to practically rebalance it, no, tax. No, I won't invest. That's why I want NPS. Everything will be done by NPS. Everything will be done by this one fund portfolio. They will do anything to avoid portfolio management, which is immature. I have come to the point, I've become so cynical having interacted with investors over the decade and a half or whatever time, that I'm saying, if you don't even know the basics of portfolio management, why should you even bother about retirement? You are very far away from that. So retirement planning, first of all, it requires some element of simplicity in your thinking. You should say 2 assets are enough for me. If I want 3 assets, then somebody will say international equity. Now there is a SIF. I want SIF. Oh, I can invest 10 lakhs. I'm a middle class guy, but I can still invest 10 lakhs. So let me add SIF also. The more you are going to complicate your portfolio, the more it becomes difficult to even say, I have this asset allocation. It's a mess. Most people's portfolios are complete mess. They want theoretical ideas about asset allocation, retirement planning, etc. But if you look at their portfolios, it's a complete mess. So I'm saying, first, don't aim to clutter your portfolio. Don't listen to people who say, oh, you can have 10% of SIFs. You can have 10% of golds, 10% of international equity. There are only 10% in a portfolio. But if you listen to influencers, there are 25, 10% in the portfolio, which is, I don't know how that's possible. So you understand what I'm saying? If you want to talk about the retirement planning, you must have clarity in portfolio management and how simple your portfolio should be. If you don't aim for simplicity in your portfolio construction, you will have a mess with your retirement planning. And people are going to curse you when you die. If you have a cluttered portfolio, people are going to curse you when you die because they want to get money from this instrument, they're going to get money from that instrument. They will curse you. Don't do that. Keep it simple. At least your nominees will be happy. Your hairs will be happy that you're this simple. You have to think like that. I'm saying the problem is there is no such thinking. There's no the everybody wants. I want a piece of that which shines today, but they don't know how to manage it. If you don't know how to manage it, stay away from it. You can't. Somebody told me this quotation by Junjunwala. He said, "You don't have to go to every party. When there's a New Year or a Diwali, there's going to be tons of parties around, and you are going to be invited to a few of them. You don't need to attend every party. You attend selected one or two, where you are comfortable. The same thing works for portfolio management. You choose something that you are comfortable with. And if you are not going to do that, which most people watching this, I'm sure, would not have, then everything else becomes pointless. I'm sorry, but that's what happens when you age and you talk to investors. You become cynical.
No, you bring up valid points, and some of the questions that I had, you already touched upon that. So great. Now, but then on that gold and international allocation equity part. So the major reason why people invest is because of the diversification and rupee depreciation issue. Now, if you're not going to invest in gold, some of the people are not bothered even if it goes higher. That is okay. If it uh, goes down, I'm going to add more, but I'm going to keep 5-10%. That's the thought process people have. Uh, so even if I don't sell it, that is okay. Uh, International allocation I must have because we don't know what happens to rupee, and then anyway, to mitigate the country risk. I'm not sure if you're educating only two assets, but if you are saying that to make it simple, just keep in equity and debt in India, then how do they counter those issues?
First of all, when people say they want diversification, they don't know what it actually means. Just because I add some percentage of gold in my portfolio is not diversified. That 10% gold is not going to protect me from anything. It's just 10% gold. It's just 10% of something. If the equity markets fall by 50%, that 10% is not going to help me. If the rupee becomes worthless, that 10% is not going to help me.
After listening to this, they are going to say, okay, I'm going to take it to 33% of my portfolio.
Yeah. But then will they pay tax? My point is, nobody, sir, that 10%, 5% will not remain 5%, 10% next year. You will have 5%, 10% today. After 2 years, when it becomes 20% or 25%, do you have the conviction to say, it doesn't matter if I pay tax, I will reduce it back to 10%? Nobody will do it. They will just leave it and call it portfolio management and call it diversification. If you do not know how the 10% of gold or 15% of gold or even 30% of gold is going to change your portfolio, if you do not know how to even quantify that, why are you adding it? I should know what the 10% is going to do to me, right? At least on paper. Forget real investments. There are so many imaginary situations where you can put it on a piece of Excel and do whatever you want, right? People say all sorts of things in Excel, right? From Excel, right? So at least put it in Excel and see what the 10% has done to you. If you're so interested, spend 1 hour, look at the data and see what the 10% does to you, what the 30% does to you. Assuming you do rebalance. At least on Excel, people can rebalance, right? Only then you must have a feel for what you want to do. when people say international diversification, they only mean FANG stocks. They are not talking about Japan. They are not talking about Europe. They are not talking about Saudi Arabia. They are talking about the big tech companies. That is all. And they will say international diversification, whatever. They just want a piece of Microsoft, Apple, etc. That is all. And that is because they're shining today. They have not shined at all time. What people do not appreciate is that those stocks did not shine at all times. There were long periods of downturns where the stocks were underwater. Amazon was underwater for a long time. Would you have purchased it when it was underwater? You should ask yourself that. Ask yourself privately. Everything is down and they've been down for 2-3 years. Will you purchase it then? Most people will not. They want, see, it's a shiny object syndrome. Whatever is shining, they want more of that in their portfolio, which is as immature as it gets. It is the schoolboy attitude, wanting more of this chocolate, that chocolate. It's as immature. I mean, it frustrates me, and I don't want to swear on you know on a video here. uh, it really, the problem is that, I mean, unless you keep portfolio management simple, it is going to come back and bite you. You should know what you are doing. I am not saying don't invest in gold. I'm saying, do you know how to manage gold if it is there in your portfolio? Can you answer that question honestly? Most people cannot. At least somebody must say, I would appreciate if somebody says, that's a good question. I don't know how to do it now, but let me add gold and then I will learn how to invest, how to manage the 10%. I will completely appreciate that guy. Nobody said that even to me. That much to me. They don't want to manage anything because it's tax. If you are scared of tax, you're not going to get rich.
The idea behind doing this with most of the investors that I have interacted with, their idea is I want to have positive portfolio return when equities tank, Indian equities tank. Gold does well, as most of the history says. Then same goes with correlation between India and US and with other countries. So if India is not doing well at that time, the other country could do well. So even if all of this combined takes my portfolio to 20%, so if the portfolio is down by 4%, it was going to be down by 2%, etc., etc. I know that doesn't hold water, but that's the thought process that people have, and I don't blame them. You look at TV channels and all of that. Everybody is broadcasting this.
That's fine. That's true. But most investors don't have a sound thought process. That's my experience. That's my
Yes.
problem is that it's absolutely fine to say I'm hedging this, I'm hedging that. Absolutely fine. But do you know how to manage that portfolio when there is no need to hedge? When equity is doing well, in Indian equity is doing well, and gold is not doing well, when fixed income India is doing well, will you still be invested with as much enthusiasm in gold, international equity? And do you know how to manage those assets when those assets are not playing the big role that they are supposed to play? That question, I have not had answers with conviction from most people. I mean,
Okay.
there's one guy who answered me well, but that guy is actually a fund manager. I mean, you have to. That's an exception, not an example.
Yes, this was my question, that most of the people do not do rebalancing. And reasons that they have is that I'll have tax implications, and let's say I have to sell equity now, but equity is tanking right now. How do I sell it? That behavioral thing that comes in. uh, so they don't do all those things. That is why maintaining asset allocation is extremely difficult. So would you suggest that somebody just goes with hybrid funds and multi asset funds, and if they have a fixed asset allocation, they can have similar equity allocation, but for new investment just go with hybrid, and that takes care of asset allocation for them, no taxable expense for you?
How many of such, let's say we recommend that. How many of such investors will stop with just one fund. Most of them will not. They will see another NFO and say, oh, is this better? I will invest there. The, they are determined to clutter their own portfolios. You cannot stop them. They're just determined. They heavily determined to clutter their own portfolios. The problem is that if you say, I'm going to keep it simple and I want to buy a hybrid fund, but what hybrid fund will I buy? An aggressive hybrid fund is typically a good choice for, but the problem is that you should understand that an aggressive hybrid fund typically holds like 70 to 80% equity, approximately 75. Okay, let's say 70 to 75%. But that's a large amount of equity. I have seen people complaining when the market crashes, they say, oh, the aggressive hybrid funds are also crashing as much as the diversified equity fund. Of course, they will crash. Something that is with 75% equity will crash almost as much as 100% equity fund. So, if you do not have the right expectations of risk, you will never be satisfied with anything, and most people will never be satisfied with one fund food. They just want to. They're always looking at something. First, they said, okay, I will stick to only Nifty. Then they said, no, let me add a little bit of Nifty next 50. Then Nifty mid cap 150 funds came. No, I will just use only Nifty mid cap 150. Then large Nifty large cap, large mid cap 250 came. Then so that's the fund. Nifty, then I'll go to 500. Then came the factor indices, quality factor, low volatility factor, alpha. It will never stop unless you tell yourself. That's the most important point. If you don't have the right behavioral trait, you will not make money. Which is why I believe financial literacy cannot be spread. Disease is spread. Financial literacy cannot be spread. People should have the right temperament, and most people don't have the right temperament to be financially literate or to be wealthy. If you don't have, you should say inaction is the most important aspect of portfolio management. See, initially, when you're a beginner, there are some things you need to do. Emergency fund, life insurance, health insurance. You build a portfolio, you start investing. That's it. After that, it should be inaction. Whatever happens, except for basic portfolio management actions like rebalancing, etc. Other than that, whatever product comes, you should say, I don't want it. I have done. Its inaction is the most important trait that most people don't appreciate. Other than, see, financial services industry, they are determined to confuse us. They will be making newer and newer and newer products every year, every month. If you are going to get swayed because you are following this influencer, that influencer, and oh, can I have 10% of that? Can I have 10% of this? Who is going to suffer? Not that influencer or that company. Your portfolio is going to suffer. So I'm saying keep it simple, but do you have the conviction to define what simplicity is for you? Each person's simplicity is different. They don't need to say, for me, without gold is simple. Some people can say, with gold, 3 assets is simple. Fine. You define your simplicity, but what is more important is you stick to it. Because the financial services industry is bound to confuse you. They will create options, more and more options. Take term insurance, for example. In the olden days, when I bought term insurance, there was only one product, term life insurance. You pay until 60 or whatever age, nothing else. Now you have return of premium. You can have monthly premium term insurance. You can have increasing cover, decreasing cover. All sorts of complications come in, and the normal Joe is confused. What should I choose? So that's the problem. You should define your simplicity, which is very hard.
Okay. So, thanks for that. Now, should someone have a separate medical corpus if they have good health insurance?
Absolutely. Absolutely. Corpus is how much ever medical insurance you have, you need a corpus, because see, we are caught between hospitals on one side who want to extract as much money as possible, typically, and the insurers on the other side who want to pay as little as possible. So you are caught between these two. And therefore, there will always be situations where there will be difficulty of the full claim not being processed, or the claim itself being rejected, or cashless being rejected. You need money. You need money to fend off. And there are so many procedures which don't come under health insurance. Because what is happening now is, especially for older people, uh, the home treatment has increased a lot. The options for home treatment, home based treatment, has increased so much that you can't cover that by insurance, most of them. So you need a huge corpus, and so you have to. The one thing I would say is that one of the biggest advantages of keeping your inflation a little bit higher, keeping your return expectations a little bit lower, is that you will push yourself to invest more. If you push yourself to invest more over 15 years, 20 years, hopefully, if luck is on your side, you may end up with a corpus larger than what your target corpus is for retirement. That extra sum can be your buffer for medical expenses, can be your buffer for replacing your equipment, it can be your discretionary fund. You can even use it for traveling, whatever, all that thing. But that's the reason why I'm saying you push it, but you can't factor it now. You can't ask a 25-year-old to add a little bit extra for medical expenses, add a little bit extra for your equipment breakdown. That guy will say, no, I'm going to unsubscribe from you. You are no good. People want motivation, right? So let's motivate them to some extent and say, okay, at least you start with something. Just get started. Do something. But over time, please reflect on your investments and keep changing those assumptions and push yourself to invest more. The single mantra for making wealth is more and more investments pumped into your investments.
Okay, so there is one question. This is mutual fund specific. I'm not sure if you would be willing to answer that, but I want to touch upon this fund because majority of the retail investors they invest in Parag Flexicap fund. Now, and many of them they do not know what to do with this fund. Should they continue? Should they not continue? Because of the AUM issue. I'm not talking about the IDCW thing that recently came. What would be your suggestion to somebody who invested in this fund because of their value style investing?
Yeah.
Do
So,
they get out because of the AUM issue?
yeah, that's a good question. And the answer is the same as gold. I want gold, but what will you do after buying gold? How will you manage your portfolio? Same question, same logic here. Okay, you want to exit. What will you do after you exit? Where will you invest? Are you going to go and invest in another active fund? And again, after 2 years, 3 years, same thing will happen. Fund manager will change, performance will change, AUM may increase. Then what will you do? Go to another active fund? Or are you going to be happy and say, no, I'm done. Let me choose index funds and let me choose a simple index fund and leave it at that. What are you going to do? Do you have a plan? The same thing like people who want to retire early. Say, I want to retire early. I want to retire. What are you going to do after retiring early? Not many people have a sound answer to that. Achieving financial independence is different. But wanting to retire early after achieving financial independence is a very different answer. What will you do after retiring early? What will you do with your time? If you don't have a solid answer to that, you should not be retiring early at all. Same thing. What will you do with your money after you exit Parag? Because there will always be some problem or other with active funds. If you want to choose active funds, you must be ready to face years and years of underperformance. If you are not ready to face it, I have faced years and years of underperformance and I have also documented it. If you are not ready, then don't choose active funds. This is the problem. You should have the right expectations. I would say the biggest problem with Parikh Flexicap is the reliance on Rajiv Thakkar.
Yes.
It is not the AUM. The AUM does not bother me too much because Rajiv Thakkar has been instrumental in keeping the fund in keeping the fund the way it is and the way it is performed.
The philosophy is still there,
Yes,
right?
but do you have any evidence that the fund house has trained other people to take over from Rajiv when he retires or when he decides to quit or start his own company, as many fund managers do? We don't know all that. So we don't know. We don't know all that. I mean, people say I trust this AMC. That is, I don't know. I mean, don't trust anything. Why do you want to trust you? What data do you have to trust anybody? You can't trust any AMC. So this is an AMC in which the late founder said dividends are unethical. I'm not sure if you've read my article on that. I have seen him speak in the unit holder meeting saying dividends are unethical. Things change. So you don't say I am trusting fund AMC. I am trusting. When investors say they trust something, they do it without any data or any information. It is an instinct, and most instincts are often wrong. Especially in personal finance, gut instinct, everything is wrong. It's common sense that this happens. Most of it is wrong. Don't trust anybody. If you are so scared, take action. Otherwise, keep quiet. You can't simply be here and there. If you want to take action, you should know what to do. Most people don't know what to do. The same problem. If you are going to be indecisive, you can't do anything in finance. You have the courage to say, I'm going to stop all my investments in this fund and I'm going to move to another fund. Fine. Do you have the courage to do that? Most people don't. They talk, they ask you questions, but they'll never act.
Okay. Long time ago, I read an article. I do not know if it is still true or not. Correct me if I'm wrong. Uh, that as per data that you saw, there is no point of investing in mid cap or small cap because they do not guarantee better returns and there is a higher risk too. What you essentially said is that if you want a little bit of spice, add a Nifty Next 50 to it. That should work for you. Now, the question is, if you see from COVID till now, most of the people that have jumped in, there is a plethora of investors and they just want to invest in small cap and mid cap. And that's their goal. So what do you have to say about that?
I don't
Do you
think
still, first of all, do you still hold that thought? Like, do you still agree and follow that thought process or has that changed?
I don't think such investors will listen to what I'm saying or even be watching this interview. I hope they're not. But I mean, they will live and learn. But the point is, most of them are young, so it's okay. They will live and learn when they see the market cycles of mid cap and small cap going up and down. Already they've seen some small example of that. They will appreciate that in equity investing, the most important aspect is lower portfolio volatility, which is the reason why I like Parikh a lot, because when the market falls, the Parikh fund does not fall as much as the market. When the market improves, the fund may not improve as much as the market. I don't care about that. Over a long term, if your downturns are protected, you get good enough returns. Maybe sometimes even alpha, but you get good enough returns. But that's a process. Young people, it's fine. But the older people investing in small cap, mid cap, they may have issues. Also, our markets are completely changing in character. Until 2020 or so, Nifty Next 50 was Nifty Next 50 and Nifty Mid Cap 150 had identical returns in terms of rolling returns over 5 years, 10 years as well. But then the Nifty Mid Cap shot away. It shot above Nifty Next 50. And then it has started coming down. And now the gap is not as much. So as the market depth increases, as more and more people come into the market, Nifty Next 50 is going to become more and more large cap like. Does it make sense?
No, it does.
So
Because,
therefore,
go
its
ahead.
risk reward may change over time. So you have to be careful with it, but it is still, as of today, it has been as volatile as ever, and it has been as frustrating as ever for anybody who holds it. But the problem I have with the mid cap index funds or mid cap funds is that if you choose a mid cap index, you should be careful about what happens during huge illiquidity issues in the market. When suddenly the investors run away from the market and the market crashes, these funds can have trouble managing those portfolio, because if the AUM of a mid cap fund increases by a large amount, let's say as big or at least 50% of the Parikh fund, selling and buying large mid cap stocks results in something called impact cost. There will be a difference in bid price and sell price. So this will create problems for the fund manager in tracking the portfolio. We have not gone through such cycles. That's the problem in India. This is something that we should deeply appreciate. We don't have much data in India in every aspect of financial planning. It's only 20 years, 30 years. And in that period, the market is changing. For example, the kind of volatility that the Sensex had during the Harshad Mehta scam, I would say it is about half the volatility or even 30% of the volatility. Hugely. Sensex was not a large cap index in the 90s, relatively speaking. But today it is a large cap index. So it's a big change. So everything is changing. So we have to be careful to this dynamic. That's why I'm saying keep your portfolio simple, keep your return expectations as low as possible so that you don't get disappointed.
Okay. So, what has been your biggest learnings in the past decade of investing? We keep learning every, I keep learning something new every other year. So, what has been your biggest learnings in the past decade?
Nothing works all the time. Whatever you do, wherever you invest, whatever strategy you have, it will not work all the time. Whether you are an active investor, a passive investor, whether you want to trade, whether you want to time the market, whether you're doing dynamical asset allocation, whether investing gold, whether you're in whatever it is, nothing will work all the time. There will always be periods when your strategy will underperform others and you have to push through that period. There's no other choice. So, and you should never ever aim for what is the best out there. You should aim for what is suitable to your life. And you should have the humility that going from point A to point B has got a million ways. There are million routes to go from A to B. I am choosing one route. It may not be, I don't know whether it's the best path, but temperamentally, it is the most suitable path for me. At least as of now, that is how I see it. And as long as you have that, you know, that humility and awareness that you can't choose the best opportunity, I think you should be okay. That's my biggest learning.
Okay, thank you. And what is the best way to park money for debt allocation? I'm not talking about EPF, PPF, because they have limitations capping and the lock in also. So if you're going to do asset allocation, you can't withdraw from PPF or EPF. So what's the best way to park for debt allocation?
Very tough question. It's a very, very important question. But the problem is our tax laws have changed. And I completely disagree with taxing debt mutual funds as per slab because there's a capital market risk. And when you are taking that risk, you should be rewarded for that risk in some way. And I disagree with that, but that's how life is. And uh, therefore, what has happened is most people don't want to invest in debt funds because they're taxed as per slab. The problem is people are always looking at tax. You should not look at tax. You should look at liquidity. You should look at the risk profile and, of course, the return profile. And therefore, if you want higher in returns from debt, you must be willing to take risk. For example, Parikh Conservative Hybrid Fund is an excellent fund. However, it is risky.
Conservative hybrid fund, right?
Conservative Hybrid Fund. It's an excellent fund. For a long-term debt instrument, it's an excellent fund, but it is risky. If you want a less risky option, you have Edelweiss short-term index fund. I forget, there's a big name for it, all sorts of names to it. There's a short-term index fund. They have only one fund. That's a good fund with about 5 years only. The bonds are about 5 years in maturity. The duration is about 5 years, which is some cost, which is okay for a long term. I would say it's a very good fund. Even for a long term, you can use it, but don't expect too much. In Parag Conservative Hybrid, the returns are good, but it will fluctuate a lot. Most people, when they invest in debt funds, they are not ready to take risk. They want returns, they want lower tax, but they're not ready to take risk. What do you? I mean, you should temper yourself with the right expectations and risk awareness.
So majority of the people, the apprehension that they have, you brought up a very valid point about the risk, but they think that if they're investing in debt, it's risk free. Though that is not true, as you mentioned, there is a higher risk. I feel, but then tax is the major issue. So do you think, right, somebody who can manage the 1 year period of amount, probably in liquid or wherever, do you think equity savings fund could be an alternate for debt instrument. That way they'll get equity taxation if they withdraw after a year, and obviously there'll be some volatility, but the equity portion is going to be lesser, and then they'll also get the benefit of tax.
Are you ready to appreciate how much these funds can fall when the market crashes? That's the question you should ask. You should find out how much these funds fell down when during March 2020 when the markets crashed, and you should appreciate that. If you can handle that, then you can see equity savings is a misnomer. You can't save in equity. You can save in arbitrage maybe, but equity savings has got a small amount of unhedged portfolio. So you should be aware of the risks. That's my problem. Nobody wants to do the research. Everybody wants answers, and you can't get that in finance. It's a very, very hard thing to do. I would say don't invest in equity savings. See, whatever you do, whether it is conservative hybrid, equity savings, there's something called balanced hybrid now. Whatever you do, there will be risks. And those risks will only be seen when the market crashes, when the bond market crashes or the stock market crashes, or together or whatever. Anything can happen. So at that point in time, will you post in social media saying I invested in funds in this fund, saying it's a safe fund, but now look at how it has crashed and so on. I see people doing that all the time. So they don't have the they don't want to do the research, and they want product recommendations. So it's a marriage made in hell. It won't work.
Okay. So thank you, Pattu. It has been a great session and a great learning session, and I'm sure many people would draw many of the things that they could use in their own financial journey, and they still remain motivated for financial freedom. Uh,
Will they remain
so
motivated seeing this?
no, they should. That's the goal, right? But anyway, thanks a lot. Really appreciate it. You guys can also visit Freefincal, uh, where Pattu writes his articles, and then he also uploads information about finance on YouTube, personal finance. Uh, Pattu, if there is anything that you want to say.
Oh no, it's been great talking to you. I hope I've kept it reasonably focused. I'm not sure. Maybe I wandered off here and there, but it was a pleasure interacting.
Thank you. Thank you.